Well, don't let the hot-performing stock market of 2021 fool you. Some investors, maybe even you, are sitting on losses in individual stocks and funds that have sharply declined in value. So how about we turn your lemons into lemonade? Smart year-end tax moves coming up next. I'm DeLegge with ETF Guide TV. Welcome to the channel. If it's your first time here, be sure to subscribe and hit the like button if you've been enjoying our content. And also hit the comment section to let your voice be heard. You know I love interacting with viewers. It's an absolute delight. In this video, I'm going to share with you some insights about how to deal with losers inside your investment portfolio that have caused you heartburn and grief and all the uncomfortable things associated with making bad investment choices. Now, even the best investors sometimes make mistakes, but knowing how to minimize the pain and how to get out of these losing positions is a strategy that you need to learn. And so there are quite excellent empirical studies that discuss the mathematical benefits of tax loss harvesting. Two that come to mind, both are multi-year studies. One is from the CFA Institute. The other is from Vanguard. And I've got links to both studies in the description section below. You get extra credit for digesting them, and they're going to give you some good perspective on why tax loss harvesting makes financial sense. So again, just hit the comment section or description section below to digest those reports. So tax loss harvesting allows you to sell investments that are down in value, replace them with reasonably similar investments, and then offset realized investment gains with those losses. The end result is that you have less of your money going to taxes and more gets to stay invested and working on your behalf. Now, ETFs can play a vital role in tax loss harvesting because when you go to replace your losers, you can do that with ETFs that help you avoid running afoul of the IRS's 30-day wash sale rules. Plus, you could stay fully invested in the market versus missing out on any potential rebound. One of the things that drives investors absolute bananas is selling a losing investment only to watch it and similar investments begin to rise in value right after you've sold out. So tax loss harvesting with ETFs, again, helps you to avoid this conundrum. Before we talk about the benefits of tax loss harvesting with ETFs, I think it's important to give you a big picture view of where your money resides in terms of the three buckets. So first, there are only three places from a tax angle where your money can be located. It doesn't matter how much money you have or how little you have. These are the only three places where that money can be located. It's either in your taxable bucket, your tax-deferred bucket, or your tax-free bucket. And in this slide, you can see examples of each of these types of accounts, and it'll just better help you understand what I'm referring to. Now, if we take a look at the next slide, you'll begin to understand that tax loss harvesting, and this is our second point, applies only to the money that you're keeping and investing inside your taxable bucket, or as I've labeled here, your TB. This bucket, for example, includes individual or joint brokerage accounts, and all of the money invested inside your taxable bucket is subject to capital gains taxes, along with taxes on any dividend income derived from your account. Now, because tax loss harvesting as a strategy is restricted to the money inside your taxable bucket, its benefits are limited in scope. So put another way, tax loss harvesting does not supersede the importance or the role of proper tax positioning of your investable assets. Keep in mind, proper tax positioning simply means you have the mathematically correct dollar balance across your entire portfolio. So each one of these buckets, again, has a mathematically correct dollar balance, and that's the big picture right there. So proper tax positioning applies to all buckets, but nevertheless, we're going to just focus on, again, tax loss harvesting as applied to your taxable bucket. So let's take a look at some working examples of what I am talking about. Examples for 2021 candidates for tax loss harvesting. So areas that have been sluggish performers our ETFs and stocks in China. We've also got biotechnology, active U.S. growth, and also SPACs, which is an acronym for Special Purpose Acquisition Companies. Now, this table shows tax loss candidates in the red, and then I threw in a few individual stocks like Alibaba and PayPal, just to give you an understanding of the fact that you can apply this same strategy with individual stocks. These companies have recently underperformed, and so if you've got paper losses, we've got corresponding ETF replacement candidates for these stocks. This, by the way, is not a recommendation to buy or sell any ETFs or any securities, but rather it's just a working example of how tax loss harvesting with ETFs can be implemented and executed. And this is a good little table for the few trading days that we've got left in the final innings of 2021. Well, that's all for today. I'm Ron DeLegge with ETF Guide. Thank you so much for watching. May good health and prosperity be yours now and into 2022. Really looking forward to seeing you next time. Thanks for watching.